Macroeconomic factors play a significant role in shaping financial markets, influencing everything from stock prices to currency exchange rates. These factors include inflation rates, interest rates, gross domestic product, and unemployment rates. Understanding how these elements interact can provide valuable insights for investors and traders, helping them make informed decisions. One of the most crucial macroeconomic factors is the inflation rate. When inflation rises, it erodes purchasing power and can lead central banks to increase interest rates. Higher interest rates tend to slow down economic growth, which can negatively impact corporate earnings and, consequently, stock prices. Conversely, low inflation often leads to stable interest rates, fostering economic expansion that can boost markets as companies thrive in a healthy financial environment. Another key factor is interest rates themselves. Set by central banks, interest rates directly influence consumer and business spending. For instance, when rates are low, borrowing becomes cheaper, encouraging spending and investment. This can lead to increased demand for goods and services, ultimately driving up corporate profits and stock valuations. On the other hand, if rates are high, spending may decline, leading to a contraction in economic activity and a potential downturn in the financial markets. Gross domestic product, or GDP, is another critical indicator of economic health. GDP measures the total economic output of a country and is a key metric for assessing a nation's economic performance. A growing GDP often signifies a thriving economy, which can lead to bullish market conditions. In contrast, a shrinking GDP may signal a recession, prompting investors to reevaluate their strategies and potentially withdraw from the market, resulting in falling prices. Unemployment rates also significantly influence financial markets. High unemployment can indicate economic distress, leading to decreased consumer confidence and lower spending. This, in turn, affects company revenues and stock performance. Conversely, rising employment figures typically boost confidence, leading to increased consumer spending and strong market performance. Investors closely monitor unemployment figures to gauge economic health and anticipate market trends. In conclusion, macroeconomic factors are interconnected and have profound effects on the financial markets. Events such as changes in inflation or interest rates, variations in GDP, and fluctuations in unemployment can dramatically impact investor sentiment and market dynamics. By staying informed about these factors, investors can navigate the complexities of financial markets more effectively and seize opportunities as they arise. Understanding these macroeconomic indicators is essential for anyone looking to invest wisely in today's fast-paced economic environment.